Let's talk about your profit and loss statement, the financial heartbeat of your business. If you're not reading this report carefully, you're flying blind. So you could be missing where your money actually comes from, where it leaks out, and whether your business is truly profitable. Every day you don't understand your P&L deeply, you risk making costly decisions that shrink your bottom line or stall your growth. This isn't just about numbers on a page, it's about real impact on your revenue, your expenses, and ultimately what you get to keep. Right now, your business is evolving. Maybe you're juggling more clients, launching new products, or adjusting prices. The P&L statement is your best tool to navigate this complexity. It tells you not just how much you made, but how efficiently you're running your operations. Without mastering this, you'll struggle to price your services correctly, control costs, or invest smartly in growth. That's why today I'm going to walk you through your P&L line by line, show you exactly what each number means, and how you can use these insights to make smarter decisions that boost your profits. We start at the top with revenue. That's all the money your business brought in from selling your products or services. Think of it as your gross sales before any deductions. For example, if you run a marketing agency and build $100,000 this month, that's your revenue. Next, subtract your cost of goods sold, or COGS. This includes all the direct costs to deliver your service or product. In the agency example, COGS might be the subcontractor fees, software licenses directly tied to client work, or any materials needed for campaigns. Let's say that's $30,000. When you subtract $30,000 from $100,000, you get your gross profit, $70,000 in this case. Gross profit tells you how much money you're making just from your core work before overhead. But this isn't your true profit yet. Now you subtract operating expenses, your rent, salaries, marketing, utilities, insurance, and even your own paycheck. Maybe that's $40,000 this month. Take your gross profit of $70,000 and subtract $40,000 in operating expenses, and you arrive at operating income $30,000. This is the profit your business generates from normal operations. Finally, subtract taxes and any interest or extraordinary expenses to get your net income, your actual bottom line. If you pay $6,000 in taxes, your net income is $24,000. Now, let's zoom in on two critical metrics, gross margin and net margin. Gross margin is your gross profit divided by revenue. In our example, $70,000 divided by $100,000 equals 70%. This means you keep 70 cents on every dollar before overhead. A healthy service business usually targets 60-70% gross margin, so you're in a strong spot. Net margin is your net income divided by revenue. Here, $24,000 divided by $100,000 equals 24%. This tells you how much profit you actually keep after all expenses. For many small businesses, a net margin between 10-20% is solid, so 24% is excellent and shows you're managing expenses wisely. Why does this matter? Because your gross margin reveals how efficiently you deliver your service. If your COGS are creeping up, maybe subcontractors are too expensive or software costs are ballooning. Your net margin shows if your overhead is under control. Are you overinvesting in office space or marketing that isn't converting? Now let's use your P&L to make smarter pricing decisions. Start by analyzing each product or service line's contribution margin. That's the revenue minus variable cost directly tied to that product or service. For example, if you have a premium consulting package that brings in $5,000 per client and costs $1,000 in direct labor and materials, the contribution margin is $4,000. Look at all your offerings this way. Which have the highest contribution margins? Are you spending too much time on low margin services? Sometimes business owners price to cover all expenses but don't factor in profit goals or market positioning. Your P&L helps you see if prices are too low. Also, identify costs that don't add value or could be trimmed without hurting sales. Maybe you're paying for multiple software subscriptions that do the same thing, or running ads on platforms that don't bring leads. Cutting those can improve your net margin without touching revenue. Common mistakes I see business owners make with their P&L include ignoring the distinction between fixed and variable costs. Not all expenses behave the same way when you scale. For example, rent is fixed, but subcontractor fees rise with more projects. Misclassifying costs here can lead to faulty pricing and cash flow problems. Another error is overlooking the tax line. Many owners forget to plan for taxes, and when the bill arrives, their net income shrinks unexpectedly. Always factor taxes into your net income projections. Finally, some owners treat the P&L as a monthly formality instead of a strategic tool. They glance at total revenue and net income, but never drill down into margins or cost drivers. This limits your ability to make informed decisions. So, here's what I want you to do today. Pull your most recent profit and loss statement. Look at your revenue, subtract COGS, and calculate your gross margin percentage. Then subtract operating expenses to find your operating income and calculate your net margin percentage. Write down these three numbers. Next, pick one product or service and calculate its contribution margin. Compare it to your overall gross margin. This simple exercise will reveal where you're making real money and where you might be leaking profit. Once you have this clarity, you're ready to dive deeper into pricing strategies and cost control, which we'll tackle next. Understanding your P&L isn't just about bookkeeping. It's about owning your financial story so you can grow your business with confidence and control. Keep this momentum going, and you'll turn those numbers into decisions that create lasting profit.